Hi there. If I had to start positioning money today from scratch, knowing what I know about the fading petrodollar story, the shipping pressure building under the surface, and the quiet race for strategic minerals closer to home, I would look at this market differently. Most people think this is another oil scare, another war headline, another week where traders panic, prices spike, and move on. But I don't think that's what this is anymore. We are living through a slow change in the financial plumbing underneath the system. And when that plumbing changes, the people holding the right assets usually do very well, while the people holding the wrong assumptions get blindsided. Today is Saturday, April 18th in New York, so before we go any further, comment below with the day and date you're watching from. And if you value the way I break this stuff down, support the channel by subscribing and commenting John A.G. Best. That helps this channel more than you think. Now, I want to be clear right up front. This is not mainly about oil. Oil is the headline. Oil is the smoke. Oil is the thing everybody can point at because it's visible and dramatic and easy to understand. But the deeper issue is what happens when the system that helped keep the dollar at the center of global trade for decades starts losing even a bit of its automatic grip. Not disappearing overnight, not collapsing in some Hollywood scene, just weakening. Quietly, gradually. Then, suddenly the market starts pricing that weakness into places most people weren't even watching. And that's why I think so many investors are focused on the wrong map. They're staring at the Middle East and saying, okay, the story must begin and end there. I don't think it does. I think the Middle East is the spark, but the portfolio consequences stretch into bonds, currencies, shipping lanes, refinery margins, and something else people barely talk about at all, which is the Caribbean, the Gulf, and the wider Western Hemisphere supply chain. Now here's the first thing that matters. I do not buy the lazy version of this argument. I don't think the dollar wakes up tomorrow and suddenly nobody wants it. That's not serious analysis. Based on recently published reserve data, the dollar still accounts for a bit under 3/5 of disclosed global foreign exchange reserves. And according to the latest central bank survey on foreign exchange trading, it still sits on one side of nearly 9 out of 10 trades. That is not a dead system. That is still an extremely powerful system. But a system does not need to die to become less dominant. It only needs to lose a little bit of its certainty, and once that happens, money starts moving differently. That's the part I want you to catch. The real opportunity is not in screaming that the dollar is over. The real opportunity is in understanding what happens if more trade gets done around it, if more countries try to reduce their dependence at the margin, and if governments and corporations start treating supply security as more valuable than cheap distance. That's a different world, and in that world, capital begins to favor hard assets, politically useful infrastructure, energy flexibility, and strategic materials that sit inside the next industrial build-out. That is where Cuba becomes interesting. Let me slow that down for 1 second, because this is where people either get it or they don't. The old arrangement worked because the world had a habit. Energy trade helped keep the dollar deeply embedded in the system, and then those dollars tended to come back into dollar assets. That habit gave the United States a huge advantage. It lowered friction. It strengthened demand. It made deficits easier to finance than they otherwise would have been. So when people talk about the petrodollar, they often make it sound mystical. It isn't mystical, it's more like a giant behavioral loop. And what matters now is not whether that loop vanishes tomorrow. What matters is whether the loop is getting a little less automatic over time. Because even a small reduction in automatic behavior can create a large market effect at the margin. That's how rates move. That's how currency expectations shift. That's how portfolios that looked balanced in the old world suddenly start acting strangely in the new one. The marginal buyer matters, the marginal seller matters, and the market is always set at the margin. Now bring that back to Cuba and the Caribbean, because this is the bridge people miss. A weakened old loop doesn't just create risk, it also creates a search. Capital starts looking for strategic relevance in places it used to ignore. And sometimes the best signal is not a press conference. Sometimes it's the fact that a place keeps showing up in discussions about fuel shortages, shipping vulnerability, metals, power systems, and regional dependencies all at once. Cuba has been dealing with exactly that kind of pressure. Recent reporting on the island's power situation has shown prolonged blackouts, severe fuel stress, and a grid that has been hanging on by its fingernails. A Russian crude shipment gave the island temporary relief, but temporary relief is not a durable solution. That sort of fragility matters because fragile systems invite outside influence, outside financing, outside bargaining, and eventually outside capital if the political path ever changes enough to allow it. And that's why I think investors need to think in probabilities instead of fantasies. You do not need a perfect reopening story. You do not need a movie-style transformation. You just need enough change, enough capital interest, enough regional urgency, and enough industrial logic for the market to start assigning value to possibilities that used to be ignored. And let me say that carefully, because people hear that and instantly jump to some wild conclusion. I am not saying a dramatic political change is guaranteed. I am not saying there's some simple, clean investment story where everybody gets rich because an island 90 miles from Florida suddenly reopens to the world. That's fantasy. What I am saying is that Cuba matters more strategically than most investors realize. Because it sits close to the United States, it has meaningful mineral potential, and it remains economically weak enough that whoever shapes its future supply relationships could end up influencing a lot more than people think. From recent geological summaries, Cuba remains notable for nickel and cobalt resources, and according to recently reported energy conditions on the island, it produces less than a third of the oil it needs. In other words, you have a place with resource relevance, but not enough internal strength to fully unlock that value on its own. That combination is exactly the kind of thing investors should pay attention to, because resource wealth buried in the ground is not the same as resource wealth that can actually be financed, powered, refined, shipped, and turned into profit. That gap right there, between what exists and what can be monetized, is where the real game usually is. And the reason it matters now is because the world is no longer having separate conversations about energy, defense, and electrification. Those conversations are merging. You can see it in how governments talk. You can see it in how industrial companies talk. You can see it in how military planners talk. Drones, backup systems, battery storage, data centers, grid upgrades, refining capacity, industrial resilience, shipping security, all of this is now part of one larger conversation about strategic capability, which means the materials inside those systems stop being side stories and start becoming central. Copper matters, nickel matters, cobalt matters, rare earth processing matters, grid equipment matters, refining capacity matters. And that is why the average investor who thinks this is just a chart about crude oil is, in my opinion, missing the entire second half of the story. Because once supply chains become political, proximity gets repriced. That's the phrase I want you to remember. Proximity gets repriced. For years, the obsession was efficiency at any cost. Cheapest labor, longest chain, lowest cost input. Keep stretching the map until the spreadsheet looks beautiful. But once wars, sanctions, blockades, insurance spikes, shipping detours, and trade restrictions start colliding, that old model starts looking a lot less elegant. Suddenly, companies and governments start caring more about reliability, alignment, distance, and controllability. Call it regionalization. Call it nearshoring. Call it supply security. I don't care what label you put on it. The point is the same. Close and dependable starts getting a premium that far and fragile didn't use to have, and that premium can show up in places the crowd laughs at too early. This is why I keep coming back to the broader Americas. Not because every country in the region is going to become some miracle growth story. They won't. Some will stay unstable, some will fumble the opportunity, some will remain too politically messy to attract serious capital. But the direction of travel still matters. If more manufacturing capacity, energy processing, mineral development, and logistics spending gradually tilt toward the Western Hemisphere, the winners won't just be the obvious commodity names. A lot of the money will be made in the toll booths around the theme. That means infrastructure, ports, rail, bulk shipping, industrial services, equipment suppliers, select refiners, utilities, engineering firms, materials processors. Sometimes the most powerful way to play a big long-term shift is not to own the flashy thing everyone on social media is shouting about. It's to own the business quietly collecting rent around the build-out. Now let me challenge one more assumption, because this is where people get trapped. A lot of investors hear a strategic material story and immediately think that means any miner with a good presentation is going to the moon. No, absolutely not. Some of these companies are value traps. Some will spend years issuing shares and going nowhere. Some are sitting in jurisdictions that look interesting on paper and awful in practice. Some have resources but no economics. Some have economics but no financing. Some have financing but no political path. A good macro theme does not automatically produce a good stock. That's why you need layers. First, there's the currency layer. The dollar-centered system is still powerful, but the automatic demand around it is not quite what it used to be. Second, there's the bond layer. If global demand for dollar assets becomes even slightly less automatic while deficits remain huge, that can create real pressure in rates and real discomfort for long-duration holders. Third, there's the industrial layer. The next decade is going to require an enormous amount of real-world material. From copper wiring to transformers, to battery inputs to specialized metals, even if some of the hype around electrification cools off. And fourth, there's the regional layer. Capital doesn't just chase what is cheapest. In stressed periods, it chases what looks secure enough, close enough, and politically manageable enough. If you line those four things up, then the opportunity set starts looking very different from the average television debate. Now, from recent market updates, the United States posted another annual crude production record, and it has remained a net exporter of total petroleum in recent years. That matters, not because it solves everything, but because it means the United States enters this period from a stronger energy position than a lot of people still assume. Add in Gulf Coast refining, export flexibility, and the ability to process, move, insure, and finance energy flows. And you start to see why the story is not simply who pumps the commodity. The real story is who routes it, secures it, refines it, and profits from the system wrapped around it. That is a much bigger story than oil alone, and I'll go one step further. Even the critical mineral story needs a reality check. Based on recent outlooks for key materials, copper looks tight for years in a way that keeps the market nervous, while nickel and cobalt look more complicated because global supply is not the same thing as secure supply. That's a huge difference. A material can look well supplied on a spreadsheet and still be strategically vulnerable if too much refining or too much processing sits in the wrong hands in the wrong places, under the wrong political conditions. So don't just think in terms of how much exists. Think about who controls the route from ore to usable product. That's where the investment thinking gets more sophisticated. And that's also why I don't think the crowd is watching the right thing. Most people are still reacting to headlines after the move begins. They want a comfortable narrative before they position. They want somebody to bless the trade. They want the chart to already look obvious. But by the time the story is clean enough for everybody to nod along, a lot of the easy upside is already gone. The earlier money usually goes to the people who can connect the policy shift, the commodity shift, and the capital spending shift before the press packages it into a neat slogan. That's exactly how large wealth transfers tend to work. They don't arrive with a polite invitation. They start quietly, with mispricing. And the people who suffer most are often the people who assume safety means familiarity. Cash feels safe until purchasing power starts slipping. Long bonds feel safe until inflation pressure returns in waves. Broad exposure without any thought feels safe until capital rotates and leaves dead weight sitting in the portfolio. And depending entirely on a paycheck feels safe until the cost of real things rises faster than the income attached to that paycheck. That's the trap. If you're successful, share your success story in the comments so others can stay motivated. So what would I watch from here? I'd watch the dollar, but not with some dramatic all-or-nothing lens. I'd watch whether its dominance keeps eroding at the edges. I'd watch deficits and duration pressure, because that's where complacency can hurt people badly. I'd watch the wider Americas for signs that energy, logistics, and materials capital keeps getting pulled closer to home. I'd watch copper, refining, grid equipment, and strategic processing capacity very closely. And I'd pay special attention to the businesses that make the whole regional chain possible, not just the obvious producers, because that, in my opinion, is where this story stops being a headline and starts becoming an investment map. So no, I'm not telling you the petrodollar disappears next week. I am telling you that the old system is aging, the market is repricing distance and security, and the smart way to respond is not panic. It's positioning, quietly, rationally, early. And just so we're clear, this is for education and discussion only. I'm sharing how I'm thinking through the landscape, not giving personal financial advice. So do your own homework before you risk a single dollar.